Hello, welcome to the first of three interviews looking at defined contribution. I'm Mark Dunne, the editor of investment magazine Portfolio Institutional, and I'm going to be your host for this series. Now, the first interview, we're going to look at the retirement landscape. And to discuss this, I'm joined by two experts. I always feel you guys could do a better job of introducing yourselves than I ever could. So, Armit, could we just start with you?
Yeah, thank you for that, Mark. And hello, everybody. My name is Armit Bhambra. Representing BlackRock. I head up BlackRock's UK corporate pensions business and have been a pensions person my whole career. So I was a consultant to begin with. And now I spend most of my day speaking to trustees of both DB and DC schemes, helping them to understand how to navigate what's become an increasingly complex landscape. So pleased to be here and delighted to be sharing the stage with Mark as well.
Thank you, Armit. And Mark?
Yeah, hello, good morning. I'm Mark Guirey. I head EMEA's insurance segment, and I am a UCAS owner and consultant coverage person at MSCI. I've worked in the UK institutional space for more than 20 years and really focusing and helping solutions providers create content and solutions for the DC market landscape.
Thanks, guys. Thank you very much. And I think a good place to start our discussion is that while life expectancy usually is what makes the headlines, retirement planners are more interested in a slightly different figure, and that's life expectancy at 65. Back in 1950, life expectancy in the UK was close to 69 years, but today that's just over 81. The retirement age in 1950 was just over 67 years, but today that's dropped to 64 and a half. These are interesting stats for looking at our retirement pots, as we have to provide for at least an additional 15 years. So, Armit, what is taking place to support this within the industry to help investors prepare for a longer retirement?
It's all good stuff. We're living longer, we're healthier, and that's good news. The subtext of what we're talking about today, though, is that we're being asked within that context to financially set ourselves up for significantly longer than we once did. And I think you spoke about a lot of numbers there, Mark, but I think the main one really is an additional 15 years of money somehow. And it's not just money, it's dignity. And it's very personal to the individual. And I think this is really where the DB system that was originally intended to cater for quite a short retirement period really unraveled. Making a promise to pay somebody 2/3 of their final salary or the career average for that additional 15 years was really a big burden. So QDC, and I think auto enrollment and auto escalation are really the foundations of the way we are set up in the UK to cater for that slightly longer time horizon. Now, within that, there is a responsibility for the individuals alongside their companies and the defaults that they're in to think about their own personal journey. Starting saving for your retirement in your 20s, given the impact compounding can have, is hugely different than starting in your 40s. So there's a timing factor to this, and there's a financial education and financial literacy piece here that we're really trying hard to bring into society. So I think it's contribution levels. I think it's when you start contributing. I think we are in a good place with things like auto escalation and auto enrollment. But I do think there's more for us to do, and as we continue to live longer, there's only more focus that has to be put on this.
Thank you, Armit. And Mark, what's your view on this?
Yeah, look, Armit touched on a couple of very, very important points in terms of the pensions landscape. That change from DB to DC, the introduction of the Pensions Freedoms Act in 2015 really absolutely transformed how the market was. The education point is obviously important. If investors can now, or members can take pensions at age 55, many of them are very short-term focused, want to take the real focus on when can they take their 25% cash, tax-free cash lump sum without necessarily thinking about what to do with the other 75%. So at retirement considerations, options are really where I think providers and the market as a whole need to provide support to members, because that point, which Armit notes, we all would, an extra 15 years life expectancies is something we would all aspire and would like to do, but we want to do so in the most comfortable fashion as possible in terms of affordability and having some sort of maintaining a similar sort of lifestyle to we have today. So really the education around at retirement, I think, is super important, but pensions freedoms, the fact of products such as flexible drawdown, etc., really have transformed the market as it is today.
And actually, Mark, if I can add one more point, we're going to come on to talk about our DC Pulse survey, and one of the statistics that came out of that, it was quite interesting. So we thought 54% of respondents to that survey felt as though they're not contributing enough to their pension scheme. So that's actually up 5% from the prior year. Now, what does that actually mean? If you're not contributing enough, what's the limiting factor? So this is the kind of thing we need to unpack.
Good point. Okay, Armit, sticking with you, Armit. In this new market regime, and I'm thinking specifically about inflation here, what are the long-term implications for savers across both defined benefit and defined contribution markets?
Yeah, it's look, going to the petrol station and paying £150 to fill up your tank, paying 40p extra for your litre of milk, or however it's manifesting itself, it's really difficult right now societally. And I think that's the first place to start, is just to acknowledge that. We got an inflation reading the other day, 9.4%, highest in 40 years. And the reasoning behind where this is coming from is multifaceted. But the point is that the implications are quite different for DB and DC markets. In DB markets, we tend to have caps and floors in terms of how much inflation can actually impact the future or the present value of liabilities. But in DC, we don't have that. So actually, we're fully exposed. And so every year, somebody's investments are being impacted by the purchasing power that is driven by inflation. Meaning that if you put £100 into your pension scheme this year, you have to find a real return of over 9.4% before you actually start getting anywhere. That's really difficult. We wonder how long the inflationary environment is going to be here. The point is the hurdle is now higher, Mark. That's basically the point, right? So in order to generate returns, we need to think a bit more creatively, given inflation is so high. And when we think about the types of assets that are in traditional DC schemes, one of the things that we're looking at very closely is how do we introduce new areas like private markets into DC investors' toolkit, if you will. If you look at the vast majority of assets that are invested in UK default schemes, they are largely in the public space. The outlook for public equities is not what it was. We've seen very, very sharp market declines, and that's not really what you want at any point in your DC journey, particularly if you're coming right to the end of it, right? So how do you introduce more sustainable inflation-linked cash flows that are diversifying uncorrelated assets? Well, those characteristics tend to lend themselves to private market products or private market investments. I think infrastructure, think private credit, think other areas that actually are very much the domain of DB investors, but we've not quite managed to cross the bridge for DC investors. And that's one of the things we're really focused on.
Interesting. Private market is something we will talk about in a later video. But Mark, bearing in mind what you've just heard, do you have anything to add to what Armit said?
Yeah, I think that key distinction between DB and DC, and the fact that in DB the sponsor bears the risk, and in DC it's down to the individual. That said, to exactly a number of the really good points that Armit made, individuals can't necessarily put private assets into their own default options, by example, but the solutions providers can, and therefore broadening out the asset allocation, considering other things, inflation protection type strategies, perhaps diversifying some of the assets more broadly, thematic indexation, thinking about inflation indexes, core and satellite portfolios that look somewhat different today, I think will be something that the solutions providers will be taking forward from here.
Gotcha. Thank you very much. Thank you. Now, according to Make My Money Matter, only around 45% of business leaders and chief executives realised that the impact that workplace pension schemes could have on climate change. Mark, how are MSCI working with their clients to set or meet net zero goals?
Yeah, absolutely. Look, I think the stat is there, and that's a number that you've just referenced. But I would say largely in all of the discussions that we have with senior folk within these solutions providers, I would put that number much higher. I think they're all very cognizant of the role that they're playing. Insurers' requirements to be sustainable, insurers' requirements in terms of solutions providers to create solutions that abide by the commitments that they're making, i.e. net zero commitments, by example. Really, in that context, we work with them in 3 different ways. The first is we work with them to assess where they are today. I tend to think of this as taking a bearing. So we use our data and our tools to help them assess their portfolios and understand where they are today. Secondly, we work with them, would work with perhaps their investment managers to think about how they might integrate and adapt their current solutions to go on their journey towards net zero. So i.e. the ESG and climate considerations, and how they might reduce the temperature of their portfolio, by example. And then thirdly, really, it's all about the ongoing monitoring and reporting. So monitoring that journey, that consideration to de-risking, that consideration to commitment around net zero, and then how they report on that report publicly and to their members, to TCFD and or fact sheets. So it's really in those ways, across the assessment, the integration and the ongoing monitoring, that we typically get work with the solution providers.
Yes, and quite interesting, because I saw that figure for the first time. I thought it was quite low as well. I was quite surprised how low it was. But Armit, how are BlackRock working towards this?
I kind of echo those points. I mean, I think that even just kind of take an anecdotal cross check of all my client conversations, the transition story, net zero is right up there. And I think Mark actually kind of set it out quite nicely. And for us, it kind of breaks into 3 relatively similar categories. So I think the first is, an assessment of what an investor actually owns. And it still amazes me sometimes, when we get into the real granular detail of how much value this can add. There's a stage before that as well, Mark, which is still happening, which is, what does it mean to you? And so we're still having lots of conversations with our investors around, how are you thinking about the energy transition? How do you think about ESG? How can we help you to define the important parameters that will set out how we manifest this in your asset allocation? So lots of those conversations are still actually happening, interestingly. Then it goes into what you own. We developed within our Aladdin systems, which is really the cerebral brain that sits within the core of BlackRock and our risk management system, something called Aladdin Climate, which helps investors really kind of at a click of a button understand from lots of different parameters, carbon metrics, CO2 dimensions, allocations globally, and just kind of see it in one place. And that's really helpful. The second piece then is the investment options and the spectrum of different choices of how to start helping them make their journey. So partly that's what we're doing in our indexing franchise with partners like MSCI, how we're evolving some of those indices to make them more aligned to things like the Paris Accord, for example. But further into fixed income, which is sometimes a slightly more challenging area, and developing new frameworks to help investors have more of a positive impact. And then further into private markets. So, one of the things I've observed is what was really largely an index equity type of conversation a few years ago is now a whole portfolio conversation. And so one of the things we're focused on is making sure people have the right options within each of those parts of their portfolio to help them get there, because this is a whole portfolio conversation. And then the last point I would just kind of mention is around the stewardship and the voting choices. So, stewardship is crucial. We have a very large indexing business, and being stewards of that capital is crucial for us. So engaging with those companies, making sure that where we are a large investor, that they're on the right journey to be able to hit those important societal metrics that get us to net zero is crucial to us as a business. We gave our investors voting choice. so the ability to actually cast their own votes recently, and that's just another way for us to give optionality to our clients in this story. So 3 key ways: what they own, analytics, the whole portfolio piece and optionality with investment strategies, and then the stewardship and the voting choice piece.
Thank you. Our final question goes to Mark. The BlackRock DC Pulse 2021 revealed that member interest in sustainable investing is growing. Indeed, 90% believe that schemes should, at a minimum, offer an ESG option. So how are MSCI working with the market to facilitate that?
Yeah, look, I think that stat is really interesting, particularly in the context of some other stats that were in that survey. One of them related to how many, the sort of percentage of individuals go with default options versus self-select, and it's in the high 90s. And therefore, for solutions providers to provide some optionality around ESG or climate solutions that members could self-select really won't cut it. Ultimately, for 90% of those that were polled to really see the impacts of ESG or climate in their portfolio, that it's going to need to be in the default option. And therefore, this really is a discussion with the solutions providers. Okay. This is all about us engaging with them to make sure, to some of the earlier points about ESG and climate data is now decision critical. We can see with the various impacts of events around the world, even the events that have happened in the UK with the highest temperatures ever recorded, over 40 degrees, and actually houses burning and being impacted by that severe rise in temperature, like the real world effect of climate change. Those considerations have to be fundamental to everything that we do from the investment perspective, to the way that we look at our portfolios, our investments, and the way that we report on that. And therefore, we engage with those solutions providers to help them consider what their default option looks like, to help them understand that the data that is out there, and work with them to adapt and change from where they were to yesterday and today, and to where they want to go to in the future. And that's really the lion's share of the discussions we have at the moment.
And Armit, how are BlackRock thinking about this in the context of the UK's DC market?
Yeah, so look, very simply put, we think it's really important. We think it's crucial. So then you get into the practical part of it, which is how do we take default strategies, make them much more ESG aligned, and get the investors comfortable with that. And I think generally investors are comfortable with that. So a couple of statistics here that I think are really interesting. So when we did this DC Pulse survey, and this was actually 2021, the 35 to 44-year-old bracket pointed to climate change being the utmost important factor when they're thinking about saving in their retirement, and a particular skew for those that had children, right? So this is a generational thing. We're very well aware that we want to leave the world in a better place than when we took it on, and right now we're a very pivotal part of that story. The statistics keep on coming. 46% believe ESG will actually make their money work better for the future for everybody. So look, I don't think there's the discussion around is this important? It's crucially important, but we're still on a bit of a journey to make this happen. For us, it's about creating very clear, transparent, sustainable indices that make it easy for people to make these types of investments. For a long time, we had a conversation around, I want to do good, but I don't want it to come at the cost of my financial outcome, or I don't want it to come at the cost of something else. We've done a lot of work of marrying those things up. We think climate risk is investment risk. We've embedded climate into a lot of our capital market assumptions. And actually, we think there's a lot of opportunities that will arise and are arising out of the energy transition. So there's absolutely a way of doing good and having a good financial outcome. It does lean back a little bit into the points around financial literacy and then the communications. But we're doing a lot around this space, and my expectation is that when we look back in 5 years' time, or 10 years' time, most defaults out there will be majority ESG strategies.
Gotcha. Armit, Mark, thank you for joining me and for sharing your views. I'm sure you've given us all something to think about. But this is not the end, it's only the beginning. There are a further 2 interviews in this series. And next up, we're picking up where we left off here by taking a closer look at ESG integration. So until then, goodbye and thank you.
Excellent. Thanks,
Thank you.
Mark. Thanks, Armit.
Bye-bye.
Bye-bye. Bye-bye.